Okay, good. So what we thought would make some sense is let's take a step back and take a look at the financing market overall. And we, given that this is a hyper-local conference, we narrowed it down to those that are engaged in assisting, facilitating interaction and or commerce between consumers and local merchants. So yes, that includes the mom and pop stores, but it also includes the large big chains and the large retailers. So what's happening out there? Well, over the last 3 years, we've seen very significant financing flow into this sector. But as you can see, 2012, down significantly. But that's not really the whole story. As you're well aware, we've seen some very, very large financings over the past 3 years, and quite a bit of capital has flowed into a very few number of companies. So if you pull out the top 3 users of financing, so to speak, over the past 3 years, it's a very different story. Now, it's still down for 2012, but not nearly as much. In fact, if you look at the skewing of the marketplace, about 1% of the capital, of the companies actually, are pulling in about 53% of the venture financing. So it's quite a concentrated market. And clearly, folks like Groupon and Living Social are two big reasons for that. So, and the other thing that we took a look at is, of those companies that financed themselves in 2010, how many were able to actually incrementally bring new financing in over the preceding 2 years? And that was about 44%. So a little bit of context, and we can use that as part of the fodder for the conversation today. What I thought we'd start with is we can do some introductions on the part of the panel. Maybe they can give us a sense for each of their firms, the stage of investment that they make, and the typical size. And then importantly, what's your basic viewpoint today, or sort of sense for the market in and around this area from a financing perspective? So Scott, maybe you can start.
Sure. My name is Scott Wolfgang. I work at Hearst Corporation. They have a captive venture fund, which is what I'm a member of. We generally invest in Series B, Series C stage expansion. Sure. I'll start over again. So I work at Hearst Corporation. They have a captive venture fund of which I'm a member of. We generally invest in Series B, Series C stage expansion rounds, generally putting to work between $4 and $6 million initially, looking to put $10 to $15 million to work over the life of our investment in a company. Because we are not a typical fund and we're investing off of Hearst's balance sheet, we have a lot more flexibility, and so we can do earlier stage things if we so choose, and so we've done a number of Series A deals as well. In terms of my sense of the financing environment for this space, I think the biggest challenge is getting over the daily deal fatigue. I think that what Groupon and Living Social did, sort of highlighting how you can actually drive offline commerce from online interactions, was incredibly innovative. But there was a lot of blowback from the way they went about doing it, and so I think that has had some negative overhang. But the overall trend of people using mobile devices and other digital devices to help them transact offline, I think is here to stay, and it's finding the right opportunities there.
Is the daily deal challenge, is that pull the oxygen out of the financing market, or is it just a backdrop that
I think
doesn't help?
It made people step back and pause, not only from an investing standpoint, but also from a company standpoint. I think a lot of companies sat back and revisited how they were thinking about their pitch because of the negativity around the deals model.
Yeah. Okay. Alan?
Thanks. I'm Alan McGlade. I'm Managing Director of DEV, which stands for Digital Entertainment Ventures. We're an early stage fund that started up last year, and we're focused, sort of laser focused on the media and entertainment space in the different verticals: video, music, games, social media, publishing, and We generally get into the seed or very early stage in a company. We've been leading deals recently where the size is about $750,000, of which we're lead, and we round up some other money. And then we help our companies follow on with Series A funding as well. We focus on digital media and entertainment because there's such a tremendous amount of disruption in that area right now. And it's really centered much more so in New York City, where the media business is centered, music business, advertising business. So we saw a tremendous opportunity to help some of these small companies along as they were trying to get their footing in media and entertainment. We have a lot of people associated with us who have a deep background in media. I just saw a report yesterday that last year was the first year that there was a significant decline in pay television subscribers for premium pay services. And they're projecting now that in the next 5 years, cable could lose 5 to 10 million subscribers. And this business is all going to migrate someplace else. So those are the kind of businesses we're looking at. In terms of hyperlocal, we look at hyperlocal in the context of media and entertainment, how it fits into that. So I'll talk a little bit about that later on. But I will also agree with you, we got overwhelmed with companies with daily deals last year. Even though we're media and entertainment, one after another was sort of a follow-on to the Groupon model, and there was tremendous fatigue around that. Very often, you see certain trends emerge, and then a lot of companies follow on, and it's very difficult. It's very difficult for somebody who's in the investing side to pay attention after a certain point when those things keep just flowing in.
Thank you. Owen.
Hi, I'm Owen Davis. I have a fund called NYC Seed, which invests in very early stage companies located in the 5 boroughs. And we have about 30 companies now in the portfolio. And we do the round sizes these days, which are very different than when we first started, somewhere about $1 million or $1.5 million and we're normally the first institutional capital with some other funds along with us. So in terms of hyperlocal, the thing that I'll add is that what we are finding, or what we are sort of looking for sort of after, let's call this phase 2, is really around sort of further refinements around advertising and ad infrastructures. Those seem the most sort of fertile areas for local merchants who have access, that can afford cheaper ad rates, or at least, have some access to, a broad sort of media buy that can be put on people's phones. There's lots of new sort of mobile advertising companies based in New York that are getting going, and they're doing quite well, and they have some quite effective sort of units. And along with sort of the long tail, the biggest problem, of course, overall, is that Google is extremely good at it. I don't know if any of you have seen sort of not just the Zagat integration, but all of the other pieces that they've started to pull together, so that when you search on a store, there's on the right-hand panel the map and the information and the whatever. And that makes almost any other business at an extreme disadvantage in terms of sort of starting up and having a really good value proposition that can sort of scale. But anyway, folks are doing it. It's primarily, I see it through sort of an ad infrastructure, and we're funding a few of those. So,
terrific. Thank you. So, is hyperlocal a meaningful label? I mean, we're at a hyperlocal conference, and is it a business? Is it a label that is meaningful, or is it a feature? Or is it just a bad idea to associate with hyperlocal, period?
Well, from our perspective, I wouldn't say it's a feature. Hyperlocal can be a business on its own, but we look at it again through the lens of media and entertainment. And we think the most important thing now is the marriage of content and context. Are you giving people the right? Are you serving up the right subject to them, the right type of entertainment that they'd be interested in? Is it localized to their needs? So it's a function of giving proper context to content.
I would say I don't think it's a feature. I mean, I think it's sort of on the spectrum of sort of e-commerce. And as things, more and more things move online, you can just sort of assume that the world will move online, right? In almost every industry. And so if you look at the spectrum of, reaching consumers and getting them to sort of transact at the macro level, this is obviously extremely important, right? A huge amount of our transactions still occur locally. So, I don't think it's a feature. I think that the question becomes, how do you make it, how do you sort of have the economies of scale to reach a highly fragmented market? And there are many startups trying to work on this. I mean, Groupon really does deserve a lot of credit for enabling this giant, building this sales group that was able to reach these folks in a way where the scale had never been achieved before in many ways. And yet, on the other hand, making that profitable, making it repeatable, and making it sort of, in the face of sort of all of the other alternatives is going to be a very difficult sort of task to do until sort of, something happens. But I think certainly the phone, and we can certainly talk about a little bit more of that.
So Owen, is distribution really a crux issue here? That practically, can you build your own distribution, or do you need to piggyback off somebody that already has it today?
Specifically for me?
Yeah.
I mean, why would you build your own distribution? I mean, there are all of these tools that are incredibly valuable for small to medium-sized businesses that didn't exist before. So if you look at sort of SEO services now, extremely cheap, clickable, right? Or they were sold, but you could go there for a minimal amount of money. They could sort of help you sort of do ad buys. There's Adaptly, where you can do an ad buy and they'll sort of put it across all social media sites for $50. I mean, these sorts of things, these infrastructure pieces, enable anyone to have access to what normally, even just 5 or certainly 10 years ago, but probably even just 5 years ago, was the realm of, you had a media buyer at Leo Burnett in Chicago, and they did your media plan, and then they contracted with Yahoo and Google and whatever, and right, all that stuff has been totally commoditized.
So you're saying it's more self-service?
It's self-service.
Part of the merchants can take on.
Absolutely.
And
it's
so
amazing.
So that solves the distribution problem?
No, it
solves, or changes it?
I think it solves, it gives everybody at least more of a level playing field than ever before. And it will only get better.
Yeah. Is there agreement that distribution is more of a, I guess, an open field today, that anybody can get to the merchant, or is perspectives?
So I think, I would agree with a lot of what Owen says. I think one of the most significant issues that needs to be solved, especially as it relates to commerce, which I think is going to be where the real money is made in this space, has to do with the fact that I think small businesses can now advertise to the masses. I think that problem has gone a long way to being solved. I think the problem that is still nowhere near solved is attribution. So I advertised somewhere. How do I know the effectiveness of that? And so if you look at a company like Google, everyone's looking for the next great mobile ad format. And if you look at a company like Google, you knew this money was going to go from offline and print advertising to online. But the way it really went was a new format called search was created that really leveraged the benefits of the online platform and the attribution that it provided, especially as it related to e-commerce. I think you need that attribution in offline commerce until we're going to see this same innovative ad model that's really going to change mobile advertising. I don't think you can get there, though, until there is some link between what I have purchased and what has been advertised. And I think that's still a significant problem that needs to get solved.
Okay, good. So let's talk about deals that you're seeing. We highlighted, the daily deal phenomenon. You don't want to look at another one of those. What are you seeing today that if it showed up on your desk, you would virtually glaze over, other than daily deals? and then on the converse side, what is it that's starting to resonate with you? Are there some themes that you're seeing? Are there some particular categories? And maybe how that fits into what you've done or plan to be doing from an investment perspective.
Well, I talked about the daily deals. I'll talk about what's resonating with me, and I'm sort of in the same camp as Owen. We've been very interested in seeing some of the hyperlocal advertising companies that are coming across our desk. In fact, we just did an investment in a company called Human Demand the end of last year, and it's a mobile advertising platform. But what we really liked about it was its ability to target very precisely local advertising, and also be able to capture the data and be able to give the transparency to the advertiser of where their commercial was going and what kind of impact they were getting on it. So we were quite taken with that company, and we're actually looking at a couple of other local advertising deals right now.
Mm-hmm. Owen?
So, I mean, there's a few things that are sort of recurrent that are unfundable, and those continually come up. Some of them many of them affect sort of the local space. So, one idea is always, Craigslist sucks, and I'm going to make a better Craigslist, and at least half a dozen times a year I'll receive a business plan around that. And then the parallel business plan is eBay sucks, and everybody knows it, and we're going to make a better eBay. Now, it's true they both do suck, but it doesn't mean that you actually, it's not an opportunity for a startup, unfortunately, just because of the sheer market power.
Permanently.
What's that?
Permanently.
You know what? I mean, it's unless something massively breaks.
So it's like taking Google on in search.
It really
Just
is.
don't go there.
So,
okay.
The other one that is sort of interesting that leads into sort of an area which does need massive improvement is, that's unfundable right now, but is, again, 6 times a year at least. Interactive, I see something on a TV show, I should be able to buy it on my phone, right? And there should be a site for me to go to, and et cetera. And that idea has been around a long time. It never works for a lot of different reasons. But what it does beg the question of is local inventory. And having somebody will crack the local inventory problem. And once there is some kind of local inventory infrastructure where I can sort of tap into and know what's in stock, what's out of stock across many, many retailers, it will open up a number of opportunities for companies. But it's extremely difficult problem. And of course, because of the fragmentation of the market, and you don't have federated stores with a single system that basically you could go into, it's really, really a big problem, and it's probably far away from actually being solved.
Do you start with the bigger chain stores that have the inventory?
Well, bigger chain stores already have it online, right? They just have they put it on their website.
Yeah.
Right? So that's not really the issue, right? It's sort of how do you get that out to everybody. But if you were able to get it out, I think there's a lot of opportunities there. So that's the stuff that sort of glazes over, and and I say, just great, good luck. But the stuff that actually people are making real progress on, which I mentioned already, was sort of the next generation of ad infrastructure companies, and they are rapidly getting better, or depending on how you look at the decline of Western civilization, worse. But nevertheless, they are, they're doing all sorts of search retargeting on mobile ads right now, and knowing location or some basic, the old Starbucks sort of example is sort of a real thing, or could be if you'd like it to be. And those pieces are definitely getting into place, and they're useful. I don't know how effective they are. They're probably a lot less effective than people think.
An area that I'm not going to say it's uninvestable, but something where I see where I glaze over is definitely someone who wants to have a marketing solution that needs to deploy a piece of hardware at the local merchant. So I was at a coffee shop in New York, and they had like 6 iPhones and 4 iPads coming off of the register. And I just don't think that, to me, that's almost like, you have all of these businesses who were these SEO or SEM agencies who were calling up businesses and saying, hey, buy my search advertising, and there was 50 different companies. I think you're seeing the same thing with marketing platforms that are trying to solve the attribution problem with deploying a device in the business. And so
even if that device is a standards-based hardware, like an iPad or a phone.
I think the challenge is right. I mean, the companies that have been successful are companies like OpenTable and Seamless, who deployed their own piece of hardware. And I think that until a business gets a smart POS system that can interact with this device very easily, I think it's very challenging to scale a local marketing services business. When you ask, do you focus on big chains? I think those are a very interesting group of people to focus on, because they do have smart POS systems, and the types of services you can deploy for those at scale is a lot easier.
Okay.
Yeah,
So
we see an interesting one of those. An example of that right now is a company called Ziosk. Are you familiar with them? They're working with Applebee's and Chili's, and they're actually deploying a tabletop device to do the menu, the ordering, so that they can reduce their workforce and just have basically busboys bring you the food. And they're rolling out pretty aggressively, and it does tie into their POS system. Yep. But they first tried it by using actually tablets and iPhones, and that didn't work very well.
Okay, so we got the bad side. Good side? What do you like in these days?
I think the things that are really interesting is, a lot of people are chasing payments. And I don't know if payments is the problem. When I show up at a retailer, paying isn't the issue I have. So I think that people that are creating different types of offline experiences, so I think Uber would be a great example, who are solving another problem but has payments built into it. I think those types of platforms and marketplaces are extremely interesting.
Does the data behind payments have value in the context of bringing that data to bear for the merchant or the retailer?
Sure.
Yeah, okay. All right, Alan, what do you...
I think I answered the question.
You did?
I started.
Okay. Sorry. Okay, so by the way, I want to open things up for questions. So if anybody has some questions, put your hand up and we'll get to you in a sec. So we talked to, I think Owen had mentioned Groupon as somebody that's actually done something quite significantly positive in spite of all the noise in the marketplace. But what other companies should we be watching very carefully, learning from, perhaps emulating, that we can be learning from as this market develops? Alan, you want to start?
Well, one thing we're looking at is the traditional media companies. For purchasing, over 75% of purchases are made within 15 miles of the home. One of the things that we've seen is that ad inventory, the CPMs are much higher if they have a local component. And there's traditional businesses that have capitalized on that for years: local broadcast, local cable, direct mail, newspapers. And so, of course, you're creating new businesses, but you're also transitioning those businesses into a digital paradigm. And I think there's a tremendous revenue pool there, and I think it's instructive to look at how they built their businesses as you think about how you create hyperlocal advertising, hyperlocal retailing.
So you look back to the past to learn for the future.
Right, and there's a lot of value in transitioning those businesses. One of the companies we're looking at is called Local Yocal, and they're a demand-side platform that's aggregating inventory for local publications that are online, like community newspapers. And they're getting a lot of traction with that because those guys haven't figured out a way to do it themselves.
So they're taking printed newspaper and allowing
that
them
are going online
yeah.
and filling advertising inventory for them.
Got it.
And
Got
so they have local sales forces, but they can tap into the national spot market so that if you have a sports authority in a community, they can localize the advertising for that community through that platform.
Okay. So the ones to watch and perhaps emulate and learn from are the old media guys and what they've been able to accomplish historically.
Huge business, massive. There were massive businesses there from,
okay.
as you know, from classifieds to yellow pages to direct mail.
Okay. Scott?
I think interesting companies to pay attention to are, I mean, commerce is an area where I'm focused on. I think looking at what traditional retailers are doing on mobile devices. So if you look at some of the more popular mobile applications, they're going to be from traditional retailers that have created a transactional or in-store experience through their device, or through their app. So Starbucks would be a good example. Someone like Five Guys, who you can do ordering on mobile. Safeway has coupons built directly into their app. So these local retailers who have the advertising to advertise their brand and their apps, the ones who are creating in-store transactional type experiences on their mobile apps, to me, I think are innovative places to look.
So these are the retailers who are innovating, and they're actually building their own apps.
Yeah, deploying functionality inside of their own apps that have a better experience.
Internally built products to better serve their customers.
Yes.
And enhance the experience.
Yeah, I mean, Starbucks would be the, you know.
So that's interesting from an investment perspective. That's not an investable sector, or is it?
Oh, I think they're services providers to those companies that are interesting. Mm-hmm. So if you can provide a key functionality as a software service, just like there are many e-commerce software service companies.
So some of the building blocks that allow the retailers to build their own applications have value.
Not necessarily build their own applications, but build functionality into their application. I don't want to have a body shop that's helping you build your app. It's, I mean, like, there are companies that help chains do online and mobile ordering. They integrate with the POS system. You know, there's a enterprise component there.
Mm-hmm. Mm-hmm. Okay. All right. Owen?
Nothing. You know, it's tougher to think about of where there are investable opportunities that are sort of bigger. There are a bunch of, obviously, these iPad-based cash registers that I think are pulling in many of the pieces that we've sort of been talking about. And once you've sort of enabled that to occur as a central spot, and it's not just Square, right? Everybody knows about Square. You plug it in and you swipe the card. But there are other companies that are offering sort of a software-based approach where you can enter inventory into the system, and it's basically a cash register. Once that information is obviously in digital format and organized, there's an enormous amount to do with it. And I think that is one of the most interesting areas to really look at because it becomes a central source. You know, point of sale systems have historically been extremely closed, entirely proprietary, and sort of expensive. And all of those things are definitely going to change. Yeah,
I mean, following up on that, we did a deep dive looking at the sort of smart POS systems. Ultimately, couldn't get there to make an investment, but what was what resonated very much as we looked into that space, it was very similar to the cell phone industry in some regards, where until an open platform like an Apple or an Android came along, there weren't a tremendous explosion of mobile apps and mobile app innovation. As local businesses have these open POS systems that can talk openly and not a walled garden, I think that's going to be a key thing that needs to occur before you see a significant increase of mobile applications that work for a local business and purchaser and customer.
Just want to add, if you could take a look at, other than sort of Square, the company that just came to mind is Shopkeep. I don't know if you know about them, but they're based in New York, and they're doing an amazing job of sort of taking iPads and making them cash registers with inventory, and it's amazing.
Okay, so we hear Square, Groupon, ShopKeep, and the traditional media guys as an opportunity to transition as well as a learning from the past. I saw a question here. Why don't we start there, and any others, please put up your hand and we'll take a few questions.
So I know that... Hello? Oh, I can talk quieter now. Scott from Spun, I spoke earlier today. I know that in the deal space specifically, but to a certain extent also in the transactional space, there's a problem with customer loyalty. Saying, I can get this deal right now, but then later I don't need to use this app. I'll use whatever app is going to serve my need. My personal opinion is that when it's all deals, it feels a little like the penny saver, where there's not a lot of loyalty. But when it's deals with great content, perhaps like the media stuff you're looking at, you see a lot more sticky usage and return usage because the content keeps you there, more like the New York Times, right? Great content with ads. I want to know all of your opinions on that. And how does content kind of fork with these monetization opportunities? Do they work together, and why?
I can hop in first, unless you want to go.
No, go ahead.
So, a couple things to say about that. One, the initial sort of daily deal, like extreme discount, and then I'm not a customer anymore. Clearly, that's not repeatable, and it will not. That will obviously, it's now phase sort of, past that initial sort of phase. Everybody realizes it, and sort of those sort of metrics of things are changing. Now, look, these are lead generation sort of mechanisms, right? Which means it is the job of the merchant to convert a customer. At the end of the day, they have to want your service repeatedly, or you're just not offering a service people want. I mean, I don't want to be sort of unsympathetic about this, but somebody just walked in the door, tried your thing out, and if it isn't deeply discounted, if it makes sense economically for you to get that lead, and you can't convert them, you've got to think about your own business. So from that point of view, I think daily deals, the economics of them will normalize, right? Their lead generation mechanism, and they're relatively efficient, so great. In terms of the content mixing with sort of like the transaction stuff, obviously that's sort of a trend that's been going on for a long time. There have been a few sort of like higher profile attempts to sort of do it. Many of them have not worked out. So everybody, I don't know if you know about the Gilt sort of like Park and Bond, which was sort of on the men's side of things. They sort of had an editorial magazine sort of wrapped around sort of full-priced products. And my understanding is, and I know Sarah spoke earlier, or maybe she's still here, I don't see that as sort of like leading the company to an IPO, sort of that division. And so, I think it's just a complicated, sort of thing where at the end of the day, you have pricing power. Are you, sure you're going to engage users, but you actually need to convert them. And I think the mechanism of editorial with that is a great way to introduce things, but I just don't know how much transactional volume those, sort of services really have. And I would question it. That's all I'm saying.
Ellen, any thoughts on this?
Well, I was talking about how you wrap content with very specific context. And one person I look at my wife, who's a vegan, and she follows certain blogs and certain sites that really appeal to vegans, organic farming, supplements, and she's ended up doing most of her transactions in the last 6 months on these sites. She orders supplements from them, she orders books from them, she orders DVDs from them, and it's because they're appealing to exactly a specific area of interest of hers. And big brands now are thinking more and more about how they incorporate really interesting content with their brand and their products, and fuse them together so well that you think as a consumer you're getting tremendous value from consuming the content, and it drives you to buy those products. If you add then the local element Whole Foods is 3 miles away. You've sort of closed the loop for it. And we're looking at some companies that try to bring those elements together. That's one of the areas I'm particularly interested in, because I really think that it's hard to separate, here's the ad, here's the content. People now really want to see that information fused together in a way that's extremely relevant to them.
Thank you. Other questions?
I'm curious if any of you see any sort of funding gaps, stages of investment where companies are having a bit more difficulty in raising capital, and sort of as a follow-on, how do you see the exit opportunity environment for companies in the sort of the hyper-local space?
I'll start. I mean, I think there's a clear funding. I mean, there's sort of this barbell where things that are very late stage are getting funded, and things that are early stage that haven't yet proven anything are getting funded. I think where there's a clear funding gap is companies that are taking longer to scale, haven't seen, gotten the enormous hype or growth in the early stages, and so in that mid stage, I think it's a tough marketplace for raising money. In terms of the M&A environment, I think it's fairly strong. I mean, you've got companies like Yelp and Groupon, and who are public, and Square, who have lots of cash. And so I think there's a lot of public companies now that are acquisitive and have a currency, and so I think it's as good a time as of ever from an exit perspective if you've got the right product.
Any other views on funding gap, exits?
Well, I guess that early stage companies get funded when certain sort of metrics are in place, or certain a view is certain in place. The funding gap sort of begs this question of there are all of these deserving companies and no one's giving them money, or actually the companies should not have been funded in the first place. And I think there's a lot of sort of the latter. Companies that are actually deserving and doing well and have sort of real traction and sort of momentum in the market get funded. Like, the market is relatively, not perfectly, but relatively efficient. And so, is there less sort of early stage capital these days sort of going to hyperlocal as a question? Yes, there definitely is. So if that was sort of a focus of a bunch of startups, yeah, they're going to have a much tougher time than sort of 2 or 3 years ago. You can't start sort of the Groupon for kids, or the Groupon for, sort of whatever it may be. That sort of, those set of opportunities and funding things are over. But it doesn't necessarily mean that those companies have gone on and sort of proven that that's actually a market that people should be sort of additionally spending money in.
But I would argue that there is money for good companies to get financed at the early stage. If you have a solid proposition, there's lots of early stage venture groups in New York in particular, angel groups. There's a robust investment community for good companies.
Okay, well, listen, I want to thank our 3 panelists, Owen, Alan, and Scott. Appreciate your perspective, and I think it's time for lunch, which